Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor. It is January 14th, 2026, and I am really pleased to have Rick van Nieuwenhuyse with me. He's the president and CEO of Contango Ore. Want to get an update from Rick. It is a company that I'm covering in my newsletter. I've really enjoyed this story so far, doing extremely well. But the big news, of course, is the proposed merger with Dolly Varden Silver. And of course, I did talk to Shawn Khunkhun, and that interview is posted at my YouTube channel, J Taylor Media. But we want to hear what Rick has to say from his side of the story. I gather they're going to be pretty much on the same page because it is a friendly merger and considered a merger of equals, I believe I read. I should mention before I say hello to Rick that I'm not being paid for this interview. I do personally own shares of Contango, and it is covered in my newsletter. As I said, the stock trades on the New York Stock Exchange, CTGO, 15.5 million shares. I believe that's all there is outstanding. $29.18 as I'm speaking to you this afternoon on January 14th. So I guess it gives it a market cap around 450 million, rough numbers, US dollars. The company has a very unique business model, which Rick will tell us about. And so really want to say hello. Thanks for joining me, Rick. It's good to have you again.
Yeah, Jay, good to see you again. We've seen each other over the years, but of course we go back. What is that? 25 years ago for Nova Gold days. You were one of the first people to pay attention to us with that little old company called Nova Gold that had Donald, and so it's great to be on your program.
Well, very reluctantly, as you'll recall, Rick, and that was at a time when at a gold show in New York City when there's, I think, maybe 10 of us there, attendees and potential investors. And the last thing I wanted to hear was gold, and you were touting your gold project there in Alaska. And oh man, give me a break. And then you said, well, the stock's selling at 8 cents. We get 10 cents a share in earnings or in cash flow. I said, well, okay, all right. So I did take a look at it, and of course that was a great success. One of the biggest winners I had, thanks to you for basically grabbing me in the aisle and making me listen, Rick. So obviously, I guess you were saying something about your mindset and how you invest as a contrarian investor for sure, and certainly you've gotten involved with Contango at a time when the market. Well, your timing was pretty good, actually. I think it was very good, and. Like Frank Giustra, I was just talking to Gwen Preston over there at West Red Lake, and Giustra jumped in about the same time to put money into that deal. So I think the smart investors recognize the time to get involved, the time to get in, the time to get out. And obviously, you've been through these wars many years, as have I, and so we've learned a few things, hopefully, over the years, Rick. Well, okay, so with regard to the merger, well, maybe before we get to the merger, talk a little bit about Contango for people that aren't aware of your business model. It is a very unique model. Some people have called it a hybrid royalty company, I think is the way it's looked at. Just talk to us about your business model and why you formed Contango Ore.
So yeah, with Contango, just to give a bit of an overview, we found a roughly 1 million ounce gold deposit, high grade, average about 8 grams per ton, which is very high grade for an open pit gold mine.
Sure.
And we made the decision proactively, let's not do what everybody else does and tell the market we're going to go build a mill and permit a mill and a tailings facility and tell the market that'll take 3 years and have it take 10, because that's not great for shareholders. It's not great for shareholder value. Yes, it can be done. It's a lot easier to do it in a market like today when gold is ripping and people want to throw money at anything that's gold. But you'll still dilute your shareholders in doing it. And I will almost guarantee you that you will overpromise and underdeliver if you're going to tell people we're going to get something done in 3 years that takes 10. So we didn't build a mill. We didn't permit a mill and build a tailings facility and all those things because we knew that's going to take 10 plus years. We had the grade, so we knew that we could transport the ore to an existing mill that happened to have excess capacity at Kinross Fort Knox. And it's a 50,000 ton a day mill, and they've been running it at about 25,000 tons a day for the last 10 years. And we knew that. And so we had this discussion with Kinross, and we ended up forming a joint venture, 70-30, 70 Kinross, 30% us. And we mine at site, and we put the ore in a truck, it's transported up to the mill at Fort Knox, just outside of Fairbanks, which is where I live. And it's processed, and we they've produced doré at site. It's a CIP mill, so it's crush, grind, CIP. They produce gold doré. It's about 95% gold, and then the silver, and then we sell that. And so we got into production, start to finish, within 3 years. Rather than spend $600-700 million building a mill and a tailing facility and spending a lot of time permitting all that, we got into production within 3 years. So, and importantly, production and cash flow. And so that's how we've been able to keep our share count down to a little over 15 million shares. We've truly added value for our shareholders. A year ago or so, the stock was $10, and now we're approaching 30. So we produce about 60,000 ounces of gold, and that the plan has always been to produce around 60,000. It's going to fluctuate a little bit. Next year is going to be a little lower. It's always been in the mine plan. It's just the sequencing. So next year's a little lower. The following year's higher. So we're generating this year. We generated over $100 million in free cash flow. So we have our other projects, Lucky Shot and Johnson Tract. We'll talk about Kitsault and the merger here going forward. But all of those projects fit what we refer to as a DSO, or direct shipping ore model. Right. So they have high enough grade that they can afford the transportation to an existing, already permitted and built mill. So that is the plan for Lucky Shot, Johnson Tract, and Kitsault fits elegantly into that plan. High-grade silver is a complement to our high-grade gold. Contango we were definitely a gold-focused company. We didn't have any significant amount of silver in our portfolio. Combining with Dolly Varden brings that nice balance. We'll be close to 50-50 when it's all said and done, and we get the resource update on the 200,000 meters of drilling that's been done at Kitsault.
Wow.
So yeah.
How soon might that? Well, we can get to that, I guess, when we talk a little more about the.
Sure. Yeah, that'll be second half next year. We got a lot of irons in the fire, lots of things going on, lots of drilling going on this year. So we can get to all that.
A lot of news in addition to the cash flow, which is always beautiful to have a company that's exploring and developing and can finance its own growth that way. So you drop your direct shipment is still the business plan going forward into the merger as well, I take it.
Correct. And in fact, how Shawn and I've known Shawn for, I don't know, 5-6 years, something like that. And always thought very highly of how he's operated his project at Kitsault and the company and done business. We got this whole concept of coming together as a company actually came out of us both looking at a potential mill to process our ores. Yeah. And so, long story short, rather than compete, we said, maybe if we join forces, this will actually make a lot more sense. So, that's to me, that's the next big step in our evolution as a company. Now, in a merged company, once we're merged, and that should take, just to go through that, has to have a shareholder vote. We expect that to be, proxy should be going out in a week or so, and that'll set the dates for the shareholder vote, which we expect will be very end of February, early March, and then the final approvals by mid-March we expect to be done. We already have 35% of our shareholders on each side, rough numbers, that have is, institutionally said they're going to support the merger. It really just does make a lot of sense.
So it's pretty certain to happen. I think what I hear you say, that you've got to go through jump through all the hoops that you normally have to do legally and so forth. But it's
Yeah. So mid-March we expect to be a merged company, and the new name of the company will be Contango Silver and Gold.
right. Well, let me ask you, Rick, with regard to Lucky Strike and Johnson Track and going forward. I mean, you're using a Kinross mill now. Not likely to be the same mill when you get over there to Kitsault, over into BC, or even Johnson Track. Is that right? Because it's located further away from the Kinross mill that you're using now?
Yes, and the main reason is actually it's a different kind of ore. These
Okay.
are both Johnson Track and Kitsault Valley are sulfide
Right.
ores.
Right.
They're not massive sulfide, VMS type deposits, but they're just, heavy sulfide.
Okay.
Johnson Track is sort of a gold bias system. There is some silver there, but there's also some base metals, copper, lead, zinc. And at Kitsault, it's a silver bias system, so lots of silver, in least most of the district,
Mhm.
but then lead, zinc, copper, and then they do have the Homestake deposit that is predominantly gold, but all of it is heavy sulfides, and so you need to float the sulfides, concentrate, produce a zinc concentrate, a lead concentrate, and maybe a pyrite concentrate if you've got copper concentrate. And then those need, to go to a smelter and refinery to make them into metal, saleable metal. So they're very different process than, say, what Fort Knox has, which is a carbon and pulp plant. So the front end of the plant's the same; it's crushed, grind, but then rather than flotation at Fort Knox, you have a CIP, carbon and pulp technology. So that now you're just directly extracting the gold. Whereas the others, you have to deal with the base metals. Base metals are a significant component, and/or the pyrite concentrate to concentrate the gold and then to extract the gold from that. So a bit more processing than what Fort Knox is currently capable of doing. So yeah, and there we have a couple of mills that we're in discussions with. So I'll have to say, just stay tuned for
Right.
developments here.
But you're pretty confident that there would be excess mill capacity somewhere that can accommodate these various projects. I mean, of course, as I understand it, the silver projects, or the projects that's coming to us, to Contango, through, or to the merger from Dolly Varden, those are further away. I mean, quite a few years into the future, right?
So about the same as Johnson Track.
Oh, okay.
Yeah.
So Johnson Track would be like,
we have a 5-year plan for Johnson Track.
mhm.
And I think, plus or minus a year or two, I think Kitsault fits into that pretty well. Now, in Kitsault's, there's 5 or 6 deposits, and kind of depending on how you want to break things up. But the Torbrit mine is road accessible. There's roughly 40 million ounces of silver there. So that's something that could actually get into production
Fairly soon.
Again. I'll say relatively quick, because nothing happens quick in the mining business.
Yeah.
There's a road there, and the road goes down to Tidewater. So it needs upgrading, so significant upgrading. So those are all things we'll take a look at, and those are all the same things that we're doing at Johnson Track.
Yeah, I mean,
yeah.
Obviously, infrastructure is important in terms of being able to haul your high-grade ore to a mill, right? And I guess you've probably given some thought to that. You mentioned Tidewater, the ability to move over water and roads and so forth, I guess, in BC and in Alaska.
Yeah, so at Man Cho, we basically put the ore in a truck. We don't do anything at site. It's mine. The only thing we do is put it into some stockpiles so we can blend it and deliver sort of a consistent feed to the mill. But it's basically direct ship ore. There's no crushing or anything else that's done at site. We envisioned a similar thing for Lucky Shot. Now at Lucky Shot, we have the advantage of the railroad is 20 miles away.
Oh.
So we could put the ore in boxes load the boxes onto a flatbed rail car, and then haul it up to Fort Knox for processing. And Lucky Shot ore is very compatible with the Fort Knox mill. It's basically quartz and gold. There's a little bit of sulfide in it, but not much. So you're going to get probably 40% of your gold with just the gravity circuit. So yeah, the CIP circuit at Fort Knox is fine for Lucky Shot. We'll definitely have a conversation with Kinross about it. But if we own our own mill and it's compatible with that processing that kind of ore, then we don't have to pay a toll to Kinross, and that'll save us a significant amount of dollars. In rough numbers at Man Cho, this is rough high level numbers, but a third of the cost is mining, a third of the cost is transportation, and a third of the cost is processing.
Wow, that much for transportation. That's
in a truck. Now, rail is cheaper than is about a third is on a per mile, ton mile basis. Rail is about a third the cost of trucking, and barging is about half the cost of rail.
Okay.
So if you're on the water, that's the cheapest form of transportation you can get to. Now you got to get it from the mine site down to the barge, and there'll be a truck involved in doing that.
Yeah.
But your big distance obviously is once you're on the ocean, things get interesting.
Yeah.
How far can you transport something? Because the barging costs are very inexpensive.
Yeah. Well, you've got some of that potential there. I realize when you look at the geography of where you're located. I'm just wondering if you can give us a little bit of, I believe you've done economics on Johnson Tract as well as Lucky Strike. Can you give us some sort of sense of how much material you might be processing in those two projects and what the sort of cost per ounce? Can you talk about that yet, or is it too early?
Well, so we certainly
preliminary studies.
Yeah, so let's start with Johnson Tract. So we did what's referred to as an initial assessment. It's the same as a preliminary economic assessment in Canadian parlance, but under 43101, we call it SK 1300 in the US. Same thing. Okay. Initial assessment at Johnson Tract. Now we used a $2,200 gold price, which was, that's not even a year ago.
Right? Oh, it's crazy. 4,600 today.
So, but at that, it was a very robust project. It had, an NPV of, I don't remember the exact number, but like 250 million and a 30, 40% IRR. And because you don't have to invest a huge amount of dollars, the total investment was about $250 million. So now we don't have numbers above $4,000 gold. So, but at $4,000 gold, it was $650 million NPV, less than a year payback of capital. And the IRR was like, I don't know, like 60% or something. And this is because of grade. The average grade of the deposit's 9 grams, and it's gold equivalent because you've got gold, silver, copper, lead, zinc. Yeah. The precious metals make up about 75% of the value, and the base metals make up about 25%. So it's really a gold deposit. It's not a zinc deposit or a copper deposit. It's a very rich gold bias system. So now at Lucky Shot, it's basically a quartz vein. We're underground drilling right now. We'll be probably releasing results in early February. I'm going to target. We'll be drilling all year. So we're underground drilling. These are relatively short holes. We're looking at let me back up. Our current resource is very small. It's a little over 100,000 ounces of gold, 110,000 ounces of gold at 14 grams per ton, 14 and a half grams per ton. Now, when we did that release, we only had a small amount of drilling underground to do that. And then we put things on hold because we wanted to focus on paying down our debt, the debt we took on to build Man Cho. So now that we've got that mostly taken care of, now we're back drilling underground at Lucky Shot. So we'll just very rapidly outline more ounces because we know where the vein is. We've got the underground infrastructure in place, so it's just about drilling holes now. And our objective is to outline between 400 and 500,000 ounces of gold we're targeting sort of a 10 to 15 gram per ton range in terms of average grade. And then we're talking about a mine diluted grade now. So you're over a 3 meter minimum mining width, which is that's ample room to mine to develop stopes. And if we were at 10 grams per ton and doing 50,000 ounces of gold a year, roughly 500 tons a day, you're going to get very good recoveries. We've done a lot of metallurgy. It's quartz and free gold. You run that through a CIP circuit, you're going to have 94, 95% recovery.
Right.
So your all-in sustaining cost, your mining is going to be very high. Your mining cost is going to be high because it's narrow
range
mining. So $200-300 a ton. Your processing costs, you sent the Fort Knox. We know what those are because we're paying now, so we know what they are. And your transportation, because we have rail at Fort Knox, at Lucky Shot, our transportation costs will be about half of what they are for Man Cho. So again, we know what all these numbers are. So I'd say today we'd be somewhere in the $1,500 to $200 or $2,000 all-in sustaining cost, and then you've got gold at plus 4,000. So it's an easy $2,000 margin. So producing 50,000 ounces of gold, that's $100 million additional free cash flow. Total investment to do that is in the neighborhood of $50 to $75 million. So which we either have or are generating with our Man Cho project from the cash flow from Man Cho. We generated over $100 million of free cash flow in 2025 from Man Cho.
Wow, that's fantastic. Is there exploration potential in these three projects, Rick?
Everything's wide open. So at Lucky Shot, it's a vein. It's hosted in granodiorite. The granodiorite is very massive. It's very easy to put development rock, your development stopes in the granodiorite. It literally is tombstone rock. And the vein's wide open. Historically, they mined about 250,000 ounces of gold at over 40 grams per ton.
Wow.
Over an ounce. It's about 1.25 ounces per ton. Now, they selectively mine. We don't mine that way anymore. It wasn't safe.
Of course.
They selectively mine and then they hand cob the ore. So they upgraded it by hand. So their grade was 40 grams per ton. That's why I say our grade is going to be probably about 10.
Yeah.
On the limited basis. And we're going to be really straightforward about this. Just mine it, put rocks in the box,
and send it off.
Maybe we send them to Fort Knox, but if we own our own mill, which we're working on, we would send them there. Okay,
so there is an idea that you might have your own mill at some point in time. And
like I said, I think I was just talking with Byron King, and I had mentioned that's actually how Shawn and I got together was, looking at a mill opportunity, and you may have mentioned it here too. So that's definitely next in the cards for Contango, buying a mill.
Rick, you have some other projects as well that are not, they're exploration projects. Do you put any money into those at all? Explore those a little bit? And I noticed that close to some of those projects, the Fort Knox, what is it? Which is a Fort Knox mill?
Yeah, the Amanita. So we'll have a program this year, modest, roughly $1 million exploration program. At both our Triple Z project, which is near Man Cho. It's actually just northeast of Man Cho. We own it 100%. It's not part of the joint venture. And it's on state land. We've had this project for a while, and the part of the claim set on state land that they'd not received title from the federal government. So we had to wait until that got done. That got done last year. So we've been waiting to drill this project for several years. So this year, we'll be drilling at Triple Z. It's a nice copper gold system. So we're excited about that. It's generative work. It's something we staked. And then the other project we'll do some drilling on is called Amanita. And that's near Fort Knox. In fact, from the property, when you look up, you're looking at the heap leach from Fort Knox. So it's very close to Fort Knox.
So is that
yeah,
the first one you talked about there, is that like a porphyry, a gold copper
yeah,
porphyry? So it
yeah.
could be fairly sizable, and is it near surface? Is
It's
it near?
right at the surface. Yeah,
Wow.
that's why we like it so much. It's basically a nice coincident copper gold soil anomaly, coincident with mag low, so magnetic alteration, mag destructive alteration, and then an IP as a coincident IP signature. So it's kind of classic porphyry, classic porphyry system.
The homestake project that comes with Dolly Varden, is that something that, what would be the timing on that, or what would you be spending money exploring, developing that at all, or what? In the
Yeah,
next,
so we will have we'll actually have a meeting next week, and we're starting to strategize and think, and think as a combined company
Sure.
already. Officially, we got to stay separate
Yeah.
till mid-March or so, but just kind of getting planning going. So we'll have about 50,000 meters of drilling next year at the Kitsalt Valley projects. Part of that will be on Homestake South, and getting, doing infill program to start thinking about completing a preliminary economic assessment, initial assessment on that. The other end of so that's kind of at the north end of the Kitsalt Valley. At the other end of the valley is the Torbrit mine, and which was historically mined. The road actually goes right to there from the Tidewater. So it needs some upgrading, but so that's probably something we'll take a look at doing, is upgrading the road. That gets you to the Torbit mine, which was historically mined, so it's a brownfield site. There's about 40 million ounces of silver there, plus a little bit of gold and some base metals. So that's something that could be put into production again relatively quickly using this DSO approach. It's good grade. It's I think it's close to half a kilogram silver per ton. It was one of the highest grade, when it operated, it was one of the highest grade silver mines in Canada.
Yeah, I understand.
And then you've got the Wolf vein, which is just up the valley from that. That's where lion's share of the new silver that has been added, that's not currently in the Dolly Varden resource table.
Oh,
Because Wolf is a brand new discovery, effectively. And so that'll be part of the resource update that we'll have second half or sorry, first half of next year, or sorry, this year.
Yeah.
Probably like, May timeframe. So, second quarter, a mineral resource update. And it's basically there's 200,000 meters of drilling that Dolly Varden's done since the last resource update.
Wow.
So it's a significant amount of drilling. Now, not all of some of it's, I'm thinking there's probably about 130 or 1,000 meters of drilling that's resource focused. Some of it's on new areas, right, that aren't I call it generative work. So that's not going to result in resource. You just targeting new areas. There's about 130,000 meters of drilling that is infill drilling on Wolf, infill drilling on Homestake, and then new discovery drilling at Wolf. So there's a lot. It'll be a significant resource update.
All right. Well, I guess maybe I'd like to ask you about, you mentioned debt. You're pretty well debt free now. Contango has.
Yeah, I think we're down.
And
We're
what
under
about
50.
and what about
150.
The gold loans? So the hedges that you have, are they?
So we're about we're under $15 million of debt now. So literally we could just pay it off. We've got the dollars in the bank. We obviously want to keep our cash for other things. And the hedges they'll be completely delivered into by the end of the year, if not before. So we'll be completely hedge free by the end of the year. We're looking at some options, maybe doing that sooner, but so stay tuned. But with gold continuing just to move up. I don't want to buy the hedges out at the top and then, have it correct $300 or $400, which I
Right.
would not be surprised if it would correct at some point here.
Sure, you would think so. Well, that's encouraging, and I guess I would imagine the cash flow that you plow back into exploration, you will be expensing that probably right away, right? You don't amortize that.
Yeah, if we're doing feasibility study, once we do a feasibility study, then it's amortized.
Oh, at the
So,
yeah.
for example, at Lucky Shot, we'll spend about $25 million this year doing drilling to support a feasibility study.
Mm-hmm.
And so we'll let the accountants figure out, how much of that be amortized, but I would suspect that be a significant amount of that.
Will be amortized.
Yeah. So then, rough numbers, we'll spend $25 million this year at Lucky Shot doing drilling. And it's mostly just resource building. Since we're underground, the geotechnical work is, you don't do a lot of drilling because you can look at it in 3D underground. So,
Right.
And we know that we understand hydrology pretty well because we're above the water table, which really simplifies life in terms of building a mine.
Yeah.
And we're fully permitted. That's the other thing about Lucky Shot is completely permitted.
Oh, good.
And so, we would expect another $25-30 million. And once we complete the feasibility study, so 25 to complete the feasibility study, and another 25 to 35 million to put the underground infrastructure in place and start mining.
Mm-hmm.
So I think we can get that. I think we can get the work done and the drilling done in 26, the feasibility study done in the first half of 27, and start the development work in the second half. And obviously, there's a fair bit of work to do, but it's not a lot of money, and we have the money. So if we're successful, you take that 400,000 or 500,000 ounces of resource, turn that into a 50,000 ounce a year mine plan.
Mm-hmm. Mm-hmm.
And I think, guiding to say $2,000 all-in sustaining costs, you're
doing very well.
You're doing
current
well.
prices. Yeah. Well, it all looks very good. One thing that just blows my mind is the idea that rising gold prices can hurt your accounting profits when you have these hedges on it. It's ridiculous.
Yeah,
God forbid, don't let the gold price go up because it's going to hurt our bottom. It's going to hurt our gap accounting, right? So,
it's driving my CFO nuts. But
anybody that can,
you have what they call unrealized losses.
Yeah.
And unrealized loss is just that, it's unrealized.
Yeah.
But it's characterized that way because if you don't deliver the gold, you have to go out.
Oh,
it's an obligation, right? You have to go out and buy the gold.
You have to go out and buy it. And that would be a big problem. And it has been for some of these mining companies that have been short for so long.
And of course, in our hedges we make money on our hedges. We don't lose money on hedges. We just don't make as much money as if we didn't have
a lot less than you would have. But how would it be known for sure? I mean, who could have predicted, when you were looking at $2,000 costs, and it's going to be a year later, $4,000 or whatever. It's crazy.
Well, so we put the hedges in place, let's see, what would that have been? 2023. And gold price was, I don't know, $1,800.
Yep.
In that neighborhood. And so look, you remember those days, the equity markets were dead.
No.
Everybody thought gold was going back to 1,200.
Yeah.
In fact, the mining companies thought gold was going back to 1,200.
Yeah.
Because they were hedging. Right?
Yeah. They wanted to keep their jobs.
Those guys wanted to keep gold's going to 4,000. We used $1,400 gold in the feasibility study. Because that's what Kinross used, and that's what all the mining companies were using. So that was the attitude of the market at the time, was that gold's going back to 1,200. And so the bankers aren't going to have a different view. They're more conservative. They're the ones lending you the money. So they're like, okay, well, we're going to make you hedge the gold at $2,000. And again, if we would have preferred to finance our share with equity. Yeah. But the equity markets just weren't there.
Yeah. Well, now with 15.5 million shares, What will your share structure look like after the merger? How many shares?
It'll double. It's a merger of equals, so it'll be 30.
30, about 30.
30.
Wow,
Yep.
still very tight then. And also
Very tight for a
insiders own
company
a lot.
that's,
I mean, I think the insiders own a lot, both companies, right? And institutions too, at least with Contango.
yeah, it's really interesting. So the short answer is, yeah, we have a lot of insider ownership. I own about 6% of Contango. My chairman owns about the same. And then similar on Dolly Varden's side, they have some Hecla's a shareholder in Fury, so they have corporate, and then they have their institutional. And interestingly enough, there's no overlap between Contango's institutional shareholders and Dolly Varden's institutional shareholders.
Oh, interesting.
And so, that's part of this 1+1 is 3 sort of a story, because you're not having somebody saying, oh, now I'm overweighted in this one company, I got to sell.
Yeah, that's good.
So, and then none of our analyst coverage overlapped either. So we'll have when we combine, each company has 5 analysts covering them, so that would have 10.
Yeah, that's good.
So it was interesting, and yeah, and like I say, I think this is a really smart merger, and I've had a lot of commentary from people in our business circle, and people like Rick Rule are like, this is a smart merger.
Rick
This
would like it
merger
because the
makes
cash
sense.
flow is there and all that. Yeah. I
Yeah.
think, any last thoughts? I mean, I guess I'd like to just maybe sum it up and ask you to sum it up by saying, as a shareholder, why should Jay Taylor be happy about this merger? Shareholder of Contango. I don't own shares in the other one. So
Yeah, so I think the merged company will have $100 million, over $100 million in cash. Will be generating on average $100 million of free cash flow from Man Cho. Once we get Lucky Shot on, that'll double. That's a couple of years away. And then we want to. So if you're an investor and you want to invest, jurisdiction is important to you, and I think it should be.
sure, yeah.
If you can invest in. I'm sure there'll be opportunities in Venezuela opening up, anytime here.
Well, I wouldn't hold my breath, but yeah.
But they will come at very high risk. And so, if you're an investor, you want to be in a safe jurisdiction, North America. And I say North America is a safe jurisdiction, and it'll be made safer because of the Don Roe doctrine.
Yeah.
Right? I mean, that's all about security. Everything that
Yeah.
Trump is doing is about security.
Yeah.
And so if you want to be an investor in North America, safe jurisdiction in precious metals, today that company would be Hecla. Producing company would be Hecla. We're building a new Hecla. Very similar metal mix. Hecla's a $14-15 billion market cap company. We're gonna, on a combined basis, will be, $800-900 million market cap company. So big enough to be significant, and there'll be a lot of institutional buying, because of the index buying that'll come with that. We're part of the Russell, we're part of the JDXJ. Dolly's on the silver, the 2 silver ETFs. So we'll upgrade. We're going to keep the Canadian listing of Dolly, but upgrade it to the TSX full board. So they'll be buying as a result of index buying as a result of that as well. So I'd say if you want, again, North America, safe jurisdiction, precious metals, pretty much an equal weighting of gold and silver, and we're a newer, younger version of Hecla. And in 5 years, I think we are Hecla.
Yeah, very interesting. Very interesting, Rick. Thank you so much for taking the time to give us your thoughts on the merger and the ongoing success that you're having. Congratulations at Contango. It's been a very exciting story so far, and I think it's going to get even more exciting, especially if we continue to have these strong metal markets. It looks really good. So
yeah, and we're going to appreciate being on the show, and we're going to continue to focus on grade. I think grade is still king. So if they're when the central banks stop buying gold, I was asked today, what's the signal that this is the top of the market might be getting a little toppy, and it's
Yeah,
when the central banks stop buying gold, pay attention
yeah, well,
because that's when the shift is. But I don't see that anytime soon.
no, at least from those outside of the G7 or the native
Yep.
base. Anyway, Rick, thank you again. Thank you so much, and all the best to you. 2026 looks like a very exciting year, and look forward to talking to you again sometime if you're available. You have time for us.
Absolutely, Jake. Always a pleasure. Thanks very much
All right, you
for
bet.
having me.
Okay, folks, that's it for this week. Next week, I'm going to have Terry Lynch, CEO of Power Metallic Mines, as with me, as well as Carrie Landis, who is now a board member of Hydrograph Clean Power, one of the biggest winners that we've had ever since Rick's Nova Gold, actually, going way back. So until we meet again, goodbye and God's blessings to you.